Today we're going to talk about trading straddles. I need to point out that options are not for everyone. You should read characteristics and risks of standardized options before trading. Okay, straddles are all about volatility. And we talk about volatility quite a bit in the options nomenclature. When I teach options classes, I'm almost always talking about volatility. And a lot of people get kind of caught up in exactly what volatility means. For today, we're just going to kind of keep it simple. Volatility is basically exactly what you think it is. Just a violent movement in a very short period of time. An explosion, if you will. This is where straddles come into the picture. Straddles are the quintessential volatility play. You're looking for a big move in an underlying stock, a straddle might be for you. A straddle is when you buy a call and a put at the same time, in which both options share the same expiration month and the same strike price. Now, you may have heard people refer to a strangle. Well, that is a straddle's close cousin. The difference is that there are two different strike prices with the strangle. It's typically an out-of-the-money put and an out-of-the-money call, both in the same expiration month. So here's what you're trying to accomplish when you trade a straddle. You want increased volatility. You want to put on the straddle and then see a big volatile move happen. That's how you get your profit. And you want that move to happen as soon as possible, and I'm going to show you why in just a moment. For those of you who have heard of straddles before, maybe taken a class where you've talked about straddles, you're probably familiar with the profit and loss diagram of a straddle. It looks just like this, a V, in which if you buy a straddle and hold it until expiration, if the stock ends up right at the shared strike price at expiration, the trade loses its maximum value, it loses what you pay for it. And in order to break even, the straddle has to rise far enough above the strike price to cover the cost that one has paid for the straddle, or low enough below the strike price to cover the cost that one has paid for the straddle. Now, here's the big secret. Here's what people don't tell you in these classes. This is useless. It's helpful only for intellectually understanding how straddles work. For trading straddles, it's completely useless. When I teach classes in a live setting and I'm talking about straddles, I make a habit of doing this. I say, how many people have ever traded a straddle before? And usually I get about, a third of the room or half the room raises their hand. And then I say, okay, now how many people have actually made money trading straddles before? And then I get like one or two people raising their hand out of, like 100 or something. It's because people trade them wrong. People trade them like this, like what we're looking at here. Buying a straddle and holding it until expiration and hoping it moves far enough. This is not how you trade a straddle. Straddles have double theta, okay? That means that when options, as time passes, options lose value. With the straddle, you own two options, a call and a put, so it gets doubly punished by time passing. You don't want to hold this until expiration. You want a big violent move to happen, and you want it to happen as soon as possible. Then you take your profits and you're off to the races. Now, it also has double vega, and we're not going to get too into that today. But that means that as implied volatility changes, it doubly affects the straddle as well, which can help you or hurt you depending on which side of the move you're on. It also has high gamma. Now, gamma means the rate of change of your delta. Straddles, when you trade an at-the-money straddle, they typically start pretty well delta neutral. But as the underlying moves, because they have high gamma, the delta changes in your favor pretty quickly. When the stock rallies, you get positive deltas, which helps you. When the stock falls, you get negative deltas, which helps you. So really, the whole crux of understanding how to trade a straddle is understanding this trade-off between gamma and theta. Gamma helps you. It is how straddles make money. Theta hurts you. It's how straddles lose money. So with that in mind, what do you want? You want movement for gamma to help me before theta can hurt me. This is a short-term trade. Don't be holding these things until expiration. That's a surefire way to lose money trading straddles. This has been Dan Passarelli with Market Taker Mentoring. You can learn more about Market Taker at markettaker.com, and you can follow me on Twitter at twitter.com/Dan_Passarelli. Have a great day and trade smart.